Coming up on Market to Market. Bird flu's ripple effect continues to run from the henhouse to the grocery aisle. Congress continues its attack on new rules governing waters of the U.S. And we'll explore the impact of the most recent supply and demand report. Those stories and market analysis with John Roach next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it. This is the Friday, June 12 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Consumer spending, which makes up about 70% of economic activity, is on the increase as Americans ramped up purchases of automobiles, building materials, and clothing. According to the Department of Commerce, retail sales rose 1.2% in May, following a slight decline in April. When the volatile automobile sector is removed from the equation, retail sales increased only 1%. Prices at the wholesale level grew at the fastest pace in nearly 3 years in May, with the Producer Price Index jumping 0.5%. The Labor Department credits the growth to higher gas and egg prices. When those factors are removed, core PPI rose a modest 0.1%. The Dow Jones Industrial Average fell slightly on the economic news, but as the trading week came to an end, reports of setbacks in economic talks with Greece sent the market sharply lower. 3 months after a devastating form of bird flu made its initial appearance in the Midwest, the first poultry farm in the region to be affected is growing turkeys again. The U.S. Centers for Disease Control still want everyone to know that the risk of humans contracting the disease is low, and as state and county fairs have begun to ban poultry competitions, U.S. producers are slowly getting back to work. But while pullets are being placed, consumers deal with the backlash of reduced supply. The number of birds impacted by avian flu topped 47 million this week, even as the temperature warmed up, slowing the speed of the virus. Nearly 3/4 of the infected poultry were hens. Turkeys and chickens across 21 states have been impacted since mid-December. This week, USDA briefed officials from 10 northeastern states about the spread of H5N2 and how the government is responding. Iowa Senator Charles Grassley says the bureaucratic slowness is keeping farmers from getting decisions on what they can do, including disposal of the dead birds, which is still happening in his state.
But farmers can't on their own decide to repopulate because if they do, and then without the federal government's approval, then there's a further outbreak. You won't get indemnity payments like you do in the first instance. So there's just kind of wait. I just think that the federal government shouldn't make that wait any longer than absolutely necessary.
Nearly 65% of the nation's total impacted birds are in Iowa. The most recent confirmed H5N2 case was reported earlier this week. The outbreak has cost the Hawkeye State, the nation's largest egg producer, 24 million egg-laying chickens and 3.8 million pullets, young chickens raised to be egg layers. The state also has lost 1.2 million turkeys in less than 2 months. The U.S. traditionally produces more than 30 million eggs beyond domestic demand. 10% of the total U.S. egg layers have been slaughtered. Industry estimates predict it could take almost 2 years to get the egg layers back to pre-bird flu levels. Iowa's egg industry is primarily responsible for liquid egg product used in processed food. To help fill the void of liquid egg, USDA opened its doors to imported egg products from the Netherlands. It's the first time in more than a decade the U.S. is bringing in eggs from Europe. Prices for egg products used by food manufacturers and bakeries doubled last month. And consumers buying eggs in grocery stores across the country have seen the price more than double since the outbreak began. Signs like these started popping up in the Texas-based grocery store H-E-B, limiting customers to 3 cartons. A spokesperson for the chain tells Market to Market they do not anticipate a shortage of product in their stores, and they are only trying to keep prices stable while discouraging purchases by commercial operations. The vast majority of H-E-B's eggs come from Texas. Washington was surprisingly busy this week. Trade, labeling, and water all rose to the top. A vote on Trade Promotion Authority, or Fast Track, passed in the U.S. House after a long and sometimes contentious debate. Republicans rallied around the potential boost to the U.S. economy, while congressional Democrats bemoaned the possible loss of jobs. In an attempt to placate hardline Democrats, a measure called Trade Adjustment Assistance was proposed. TAA was designed to pay for retraining if any jobs were lost as a result of a trade deal. Labor lobbies came out in strong opposition to the measure, as subsequently it was defeated. But the two measures were tied together, and without passage of both elements, the legislation is essentially dead in the water. Congress also appears to have cooled on country of origin labeling. The controversial measure was repealed by the House in light of a ruling by the World Trade Organization that cool was discriminatory to Canada and Mexico. And more pushback was felt by the Obama administration as a Senate committee moved to repeal new rules on how waters of the U.S. are defined. A few members of the U.S. Senate joined some of their colleagues in the U.S. House of Representatives, claiming new rules defining waters of the United States were nothing more than governmental overreach. This week, the Senate Environmental and Public Works Committee passed legislation requiring the EPA and Army Corps of Engineers to withdraw and rewrite rules issued in May. Those rules changed how bodies of water are defined and regulated under the Clean Water Act. EPA officials say the new code would cover streams, rivers, and lakes with a direct and significant connection to larger bodies of water downstream. The changes are being made by the federal agency in light of 2 Supreme Court rulings that left 60% of the nation's streams and millions of acres of wetlands without clear federal protection. Government regulators claim the new definitions keep current permitting requirements for agriculture in place. Nevertheless, many walking the halls of Congress, as well as the main streets of rural America, believe there is too much wiggle room in how the rule can be enforced. Republicans in Congress say the new regulations would expand current law and be a costly and confusing burden for landowners and farmers. Leaders in the U.S. House characterized the new statutes as a raw and tyrannical power grab. Some Democrats have supported efforts to block the new rule. However, one top-ranking senator on the Environmental and Public Works Committee called the legislation a backdoor repeal of the Clean Water Act. And more than a few farmers and agricultural lobbying groups have expressed concern that every stream, ditch, and puddle on their private land could now be subject to federal oversight. A spokesman for the National Cattlemen's Beef Association said, "The final rule poses an unnecessary threat to private property owners and cattle producers across the country." But some agriculture groups, like the National Farmers Union, came out with limited support of the new code, saying, "While the rule is not perfect from our perspective, the final rule is an improvement over the proposed rule." Despite efforts by Congress to get the new rule rescinded, the White House has threatened to veto any legislation that might make it to the president's desk.
Next, the market-to-market report.
Sufficient rain and warm temperatures throughout the grain belt have helped set the stage for another banner year. Even though farmers and prognosticators alike have been surprised by a fickle Mother Nature before, the June World Agricultural Supply and Demand estimates reveal adequate supplies and predict a bumper crop. Old crop U.S. corn ending stocks are pegged at 1.88 billion bushels, 1.4% higher than the May report and 50% above last year. New crop corn ending stocks are expected to hit 1.78 billion bushels, also 1.4% higher than last month's report. The report put old crop corn stocks to use ratio at 13.8% and the new crop at 12.9%. Old crop corn world ending stocks are pegged at 197 million metric tons. The calculations are 2% higher than the May report and 13% higher than last year. The global ending stocks-to-use ratio for old crop corn came in at 20.2%, while this season is expected to be 19.7%. Old crop domestic soybean ending stocks are estimated at 330 million bushels, 6% lower than the May report, but up 250% from last year's drought-tightened supplies. New crop soybeans are predicted to drop to 475 million bushels, 5% below last month's estimate. The stocks-to-use ratio for old crop soybeans came in at 8.8%, and the new crop stocks-to-use ratio declined from last month to 12.7%. Old crop world soybean ending stocks are slated to be 83.7 million metric tons, 32% higher than last year. The global stocks-to-use ratio for world soybean ending stocks for the 2014-2015 crop year are at 28.5%, while this season is predicted to be at 30.5%. And old crop U.S. wheat supplies are set at 712 million bushels, 20% higher than last year. New crop supplies are projected to be 814 million bushels, a little more than 2.5% above the May report. New crop domestic ending stocks are based on predictions of bringing in near-record crops during the 2015 harvest season. Wheat production is predicted to be 2.1 billion bushels, an increase of 5% over last season. Corn production is pegged at 13.63 billion bushels, placing the haul in the top 3 corn harvests of all time. And the soybean harvest is predicted to put 3.85 billion bushels in the bin. If realized, it would be the second largest harvest on record.
Grain prices fell this week on the bearish news in the report, as well as rumors of a record crop of a large corn crop in South America. For the week, July wheat was down 13 cents, while the nearby corn contract declined 8 cents. Soybeans were a rare winner with a modest 2-cent gain on the July contract. Nearby meal prices followed suit with a rally of $12 per ton. In the softs, July cotton gained 6 cents per hundredweight. Over in the dairy parlor, June Class 3 milk futures rose 8 cents. In the livestock sector, prices moved mostly higher as the August cattle contract rallied 23 cents. Nearby feeders rose $1.55, and the July lean hog contract gave up $3. In the currency markets, the euro gained 1 basis point against the U.S. dollar. Crude oil increased 83 cents per barrel. COMEX gold rallied by more than $11 per ounce, and the Goldman Sachs Commodity Index went up 2 points to settle at 437.50. Here now to lend us his insight on these and other trends is our senior market analyst, John Roach. John, welcome back.
Thanks, Mike. Nice to be here.
Well, and we're glad to have you. Let's talk about this wheat market. We've seen incredible volatility, both up and down. This week, down 13 cents. Where are we in the swing?
Well, actually, the wheat market has done a very good job of reacting the way it should according to our program. We've had excellent buy signals and excellent sell signals for several different cycles here over the last 3 or 4 months. This week, we peaked it. We took Chicago July wheat all the way up to the 200-day moving average. So if you think about that, it's the equaled the price, the average price for the past 200 days. And that's a pretty strong price level, and the first time we've touched that line in months. So that's the kind of power that we've had here. Unfortunately, we ran smack out of buyers when we got there, and the market quickly gave up some of those gains. The uncertainty with crop conditions as we're moving into the harvest down there, the uncertainty we have in some other areas in the world as far as the conditions are concerned, and then the real uncertain situation out there is the Russian a levy situation where they're having to put on a tariff that's based on what the Russian ruble value is, and it makes it very difficult for them to be able to sell any wheat under that kind of circumstance. So those are all the things that are kind of working in here, but in reality the market is cycling back and forth very nicely, and we just had the peak, and now we'll find some sort of a valley, and I think we'll come back for another peak.
All right, so if you didn't sell at the peak, probably time to hold. Let this thing
be patient,
work its cycle.
Be patient, let it cycle back down, and look for another rally back up again. And we may well have to get out of harvest before we can get up there. But if we could clear that 200-day moving average, we have a lot of speculative shorts that are going to be really on the wrong side of a new uptrending market. So that's the optimism that's out there. And the market signaled this week that it wanted to do that.
And if we hit that and they get a little scared, that could be a fairly tremendous pop. To the upside on short.
We could have a good run up. We could absolutely have a good run. Remember, our number one competition out there on price is the former Soviet Union and the whole Black Sea region, and the biggest surplus there will come out of Russia. And with this tariff program they have, there's a lot of uncertainty as to how they're going to be able to export.
It's essentially an export tax.
Exactly.
Now, as we move in to talk about the corn market, are we just following wheat in this market today, or are they trading some independent variables as well?
Well, I think there's a lot of outside factors that are contributing to the volatility that we have. We've had huge moves in the bond markets. These interest rates have had a big run up in the middle part of the week, early part to the middle part of the week, and then it turned around and went right back down again. The dollar has been swinging over quite a bit of distance, and so there's a lot of other kinds of things that are going on there other than just the supply and demand of wheat.
So where do you see the corn market headed in the short term?
Sideways. We have big carryovers this fall, so that's going to keep a lid on the top of it. We have about 75% of the crop rated good to excellent. That's going to keep a lid on it. However, we didn't get all the corn planted, and so that's a little bit of a positive factor. We think it might be 1 million acres. And then we've also planted corn and then had just horrendous rains on it, and we've had a lot of losses that have occurred because of those heavy rains. But in other areas where we didn't get too much rain, it's an ideal looking crop. So you really have both pro and con factors here that will likely keep the corn market in a sideways kind of a pattern, which is really what it's been now for the last 3 or 4 months, sideways to sliding down. We think now it's a dead sideways market, and then depending on how the weather is, we'll either have to rally back up a little later or we may tail off all the way into harvest.
Now, anything on this week's World Agricultural Supply and Demand Estimates report that threw you one way or the other? Anything really come out of the blue?
The only thing that was a surprise really came on the corn side, and it's because of the production in South America, mainly Brazil. Carry-in numbers were bigger than what they had thought they were, and so that made a bigger carryover number out into the fall of 2015 for South America. Okay. So we think we have to pull our optimistic ideas on corn. We thought we'd have $5 May corn 2016. I'm going to drop that down and say, let's talk about some 460, 470 corn, because the supplies are bigger than we thought they would be.
But still looking towards a harvest low. I mean, heading in that direction, following trends.
We should trend on down if the weather is good. It's going to take a weather problem, or we're going to have to find that fewer acres were planted, or we're going to have to find something new in order to get much of a rally out of this corn market. But I also don't see a huge decline. So, I mean, it's just, I think, a slow grinding situation until we get into harvest. Sometimes we pause and have rallies due to weather.
And you're stable here, not in a buy or a sell position?
We had a bicycle about 2-3 weeks ago, which came right on time, and we had a sell signal this week. We called our customers this week with sell signals in both corn and beans at the higher prices this week.
All right, now you mentioned soybeans, and now we've mentioned the wet weather. We've got a question here from one of our viewers on Twitter, Wayne in Buffalo, Minnesota. So he's up in Minnesota. We've heard similar questions from folks in southwest Iowa, in Missouri, and all across the southern plains. It's hard to have a strategy when the crop is not yet planted, or when it is planted and it's very behind. And as we look at the soybean acres that are so far unplanted, particularly in the southern Corn Belt, How should producers be planning to market that crop that is not yet in the ground on the soybean side?
Well, I think you make it simple. Just make it really simple. If you sell it now, you're going to take a loss. You don't know what you have. You're worried about that. So the thing to do is to just be patient. Wait. You'll know more 2 or 3 weeks from now, and your decisions will be better decisions. There's no incentive, in my opinion, to rush out to sell a cheap price. You may need to figure out how you're going to hold inventory. You may need to think in terms of, well, I can sell inventory and buy paper back. You may need to think about some different strategies that are a little different from normal, but at the moment, going out and making a sale with these kinds of uncertainties at these poor profit levels, why?
If this were $16 beans, you might have different advice.
It's an easy choice.
Right,
yes.
But at where we are this week, talk about these new crop soybeans, John. We've been up and down this week. We traded under 9 for a little bit. Where do you see us going here in the short term?
Well, it's the same kind of picture here. We've got a crop that's not all planted. It could be several million acres, actually, and we have a crop that's being flooded in some areas, and so we really have some issues. But what we don't know is we still don't know where the plantings are going to be when we're finished, and we don't know really the kind of conditions we're going to raise the crop under. So we still have more uncertainty because of that. Now, if that uncertainty turns into good crops, better acreage than we thought maybe, then obviously we're going to have cheaper prices as we go down the road. We have big surpluses of soybeans this fall and even bigger surpluses the next fall. But we're already trading that. That's already well known by the market. We saw that in the report this week, and yet prices really didn't go down.
And now you've been talking for the past 9 months, possibly a year, about the tremendous demand that's out there, both on the corn and the soybean side. And on soybeans, as we sit here today, crush margins are still excellent in most of the U.S., so it looks like that demand is staying very, very strong. Is that helping to slow our descent in this bean market, or do you think the market is discounting those figures, planning on a 475 million bushel soybean carryout for 2015?
What it really does, we've already discounted it and we've already traded the bigger surpluses and so forth. What the market has to do is it has to source those beans. In other words, you have to get that farmer who's standing there in an uncertain situation to make a decision to go ahead and make a sale, and sometimes that takes a bid up in price. We have to run up a little bit in order to entice a few of those sales and then slide back down as soon as those sales come to the marketplace. So again, sideways kinds of markets here until we know more about what this crop size is.
Okay. Well, then let's jump down into the livestock markets. We saw August feeder cattle relatively steady on the week, up 23 cents. Where is this market today, John Roach?
Hot. It's hot.
Going to stay hot?
I think it probably will. I mean, we're in the expansion stage. Now's when you pull the heifers out of the herd, and they've been doing that, and put them into the, or not out of the feedlot and put them into the herd, sorry. And that's probably going to continue. The cattle market is in pretty good shape. We thought this week it might make the surge higher, and it was all dressed up for a party, but the packers didn't follow, and the dressed beef didn't go up as much as what they thought it was going to, and so packer that's been losing money, losing less now than what they were, but still taking losses.
So what's your advice to producers out there with pens full of cattle here to be marketed over this summer? Are you selling at this price, or do you wait for that surge that we were anticipating perhaps this last week?
I think you have to market cattle as the cattle are ready. Now, one of the things that's interesting is that the weights have really come down. It looks like for the last 5 weeks that we've under-marketed through most of that period, but the weights haven't gained. In fact, as they've gone the other way, we've gotten lighter. So we think that you just market the cattle as they're ready in here and understand that on strength, you have to be a seller.
And you're not a seller out into the November, December, end of fourth quarter, first quarter next year?
No, and not unless you like the profit levels and and want to go ahead and secure that, fine. Otherwise, we're just very selective when we make our sales.
So do you see that strength from the fat cattle market continuing to support this feeder cattle market here in the mid to low 220s?
I'm not sure how much people will be willing to pay for the feeder cattle. A lot's going to have to do with what the corn prices are. And see, as the corn price outlook softens, the feeder cattle price level moves up. And we think that could be what happens if weather conditions all or beneficial. And so, and what we do think for the person who's looking at buying feeder cattle, you also have to buy your feed. You have to, we got to buy signal and corn, you need to get feed needs purchased out into this next year.
Okay, okay. Now as we look down at the lean hog market, this market has sold off fairly aggressively here over the past 3 weeks. We've went from 84, 85 up in there down to 78 this week. Is the nature of that market changing? Are we just seeing people move away from pork for whatever reason? Do you expect the sell-off to continue?
I think we've seen the peak. In I should say the bottom of the slaughter and probably the peak of the price. It's June, it's the middle of June. I mean, this is when you tend to put your peak in and then you tend to slide downward, and we think that has started. We broke down some trend lines in the futures, and we think we have some lower prices out ahead.
Do you think, do you have an idea on how low those lower prices could be?
I don't know. I do think that we're in a fairly aggressive expansion stage, and I think that continues for a while. I think the problems with the poultry and the egg industry, I think encourages pork producers to maybe expand a little bit more, and it's helping a little bit on the pork demand. Restaurant demand is very good. The graphs I see on that's all strong. More meals at restaurants than at home, and so there's positive factors out there on the demand side, we think.
All right. Now, you mentioned at the top of the show the outside markets that have been influencing the grains and the livestock, and of course the U.S. dollar has been one of those. June is a big month for the dollar with all of the activities related to Greece. What's your take on this dollar move here as we look to the next 2 weeks to finish out the month of June?
We drew a broad support zone underneath the dollar index is what we follow. And we've, for the last 2 months, been dipping down into that support zone, but that support zone has held well so far, and we bounced back out the top of it. Now we're sliding back down into it again. The dollar seems to be kind of the back end of an interest rate market, and the interest rates have moved huge distances. They're talking about the lack of liquidity in the bond market, one of the biggest markets in the world, and they're worried about the liquidity. So as interest rates go up, that means bond values go down, and so we're worried about interest rates. We think interest rates will go up, and we think that'll help strengthen the dollar.
All right. Well, thank you so much for joining us this week, John.
Thank you, Mike.
That wraps up this edition of Market to Market. But John and I will continue our discussion and answer some of your questions in our Market Plus segment online. You'll also find audio podcasts as well as streaming video of our program exclusively at the Market to Market website. And be sure to join us next week when we'll examine efforts by 2 cities in one Midwestern state to provide clean water for their ratepayers. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. And by Sukup Manufacturing Company, offering a full line of grain drying and storage equipment and steel buildings. Sukup Manufacturing is on a mission to protect and preserve your crop and the tools that produce it.